Okay, hello traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Tuesday, January 9th. A very happy new year to you guys here as well. Great to be with you guys back on board. Lots to discuss today. So I do have on the docket, well, obviously take a look what the DXY is doing early in the session. Euro, Aussie correspondingly on the move. Kiwi still holding below resistance. So I'm still watching that with a hawk. Sterling Key, the trade that I presented yesterday, that's the one that I'm looking at in the event that we do get Kiwi weakness. So that's one that we're looking at that's sitting at support. We'll go over that as well. Euro, Aussie, and crude from last night, as well as the dollar CAD trade. If there is anything you didn't hear mentioned that you would like to have, that you'd like to discuss rather, as always, feel free throughout the course of the webinar at any point, throw any questions that you might have. Good morning, Johan, Mark, Pete, Peter's in the house, Pooja's in the house. Great to see you. Tom, Ziad, good to be here with you guys. So let's jump right in. Aussie yen, please. Levels on the downside. You got it, Pooja. We were following that last week, right? We'll take a look at Aussie yen as well. Okay, so first things first, as always, I like to start with the DXY, just get a quick figure on where we are. Here's the weekly charts. You guys have all seen this before. We talked about how the fact that we're starting the year and the month at this point, I guess, right above this near-term support. Okay, 91.93, the swing low from 2016. Okay, it's the 38.2 retracement of the entire advance from the lows in 2011, and at this point has been a pretty decent support barrier, just lower. Okay, you have the low week close for 2017. That's 91.33, and that's going to be the breakaway. So once we get below that, it would suggest resumption of the broader uptrend. The immediate threat, though, still remains for a little bit more of a bump higher here in the index. Okay, you could see it in near-term price action. You could see it in momentum. And on the upside, near term, immediately we are running into some resistance. I'll show you that in the near-term charts in a moment. But the weekly chart does leave a little bit more room for an extension back into the median line. That would still take you back into 93. So, you know, our broader outlook for the dollar analog that we've been following does still call for sideways to higher in near term before turning lower. Ultimately, we do think this thing turns lower. The immediate threat, though, still, I think, is for a bit of a stretch here for the index. So looking at this from the weekly chart, you have room to 93. Near-term support still 91. 91.33 is the level of which would mark resumption of the broader downtrend. Okay, so the big picture is pretty clear as far as where we should be looking for the index. Looking at this on a nearer time frame, the 618 retracement of the advance off the lows that we made last year is now serving as resistance. So it was perfect support, was perfect support, was perfect support. We gapped lower, okay? And here's the reversal and tested resistance, 92.60 being near-term resistance on the index. Now, again, just higher at 93, that 2016 low day close, same as the low week close. They have also the 100-day moving average and slope all converging just above the 93 handle. So the levels, again, you know, near-term resistance, we're testing it right now as we speak. A topside break, you look for another 60 pip rally or so into 93.06, 93.10, that little confluence region of resistance. With near-term support still 94, 94, excuse me, 91.90 here. So thinking you get a little pullback, maybe the stretch higher still into this region. You look for a little bit more concrete short entries, but as it stands right now, objectively, this is breaking not only the initial weekly opening range, but also the initial monthly opening range. Here's your monthly open for the year. You sat on support for 3 days, 4 days, 5 days, tapped yesterday again on a reversal, taking us higher. Suggests you should be looking for a little bit more of an extension here in the index. So price action, pretty much going in line with the analog that we've been looking for sideways to higher in the greenback. Looking at this at an even closer time frame, here's what it looks like on the 240-minute chart. We threw this on yesterday in the webinar. If you're with me on Daily FX, I just tossed this on there and I said, you know, it's too early to really rely on it, but it does highlight further that 92.59 level. Well, we got that clip a little bit outside of the realm of time, but we still got that clip of the 618. So still some room. Like I said, I think this thing could extend higher. The near-term bullish invalidation level for this rebound here in the index is right around here, just above the 92 handle, 92.12, 92.13. You're basically looking at former swing lows, former swing highs. And if this formation is intact, that converges basically right there at that median line. So, on the way up here, even if we were to stretch into early U.S. trade, don't get too excited until we clear this upper parallel that takes to 92.72. But really, from a lateral level, if we do break this zone, 93 is definitely a level I'd be looking for as both a target for the extension and a possible entry for exhaustion for a move lower off that mark. But I do think you need to respect the index at these levels here. Any questions on the index? We're pretty stable on this. And I know, guys, just on a side note, I know things have been kind of slow lately. It's been very difficult to get excited about trades. A lot of the trades a lot of the majors are trading at major key levels, but the vol is just not there. The volatility is just not there. So when we come into these times where volatility seems to fall deeper, as I said in the note yesterday, that gives me confidence. Remember, guys, extreme periods of low volatility are always precede surges in larger volatility swings. So something's right around the corner. We want to be ready for it. And the index would leave us looking for entries on a move near 93. Okay. Making good time on the DXY. Not much to update from yesterday. So that's number one. Number two is euro. Euros continue to move lower. Obviously here, not surprising with the dollar strength that you're seeing. So we'll look at the euro dollar from all different time frames. A couple things to note right off the bat. A, the level of which we turned at and why we started to look for a little bit more of an exhaustion trade is that 2042 level, the 2012 low, the swing low that we made, and also don't forget, it is the concerted 2017 high day close, which comes in at 2035. So you're basically looking at like a 9 pip spot, a pretty significant resistance. We noted that resistance early in the week. We tried to push through it last week. It failed. This week we opened just below it. And the threat, both from the tired momentum picture that you're looking at here and just from basic price, was for a pullback. Near term, there was some upslope that we were trading with. Well, that was right here. I'll show you in a moment in near term. But here's the daily chart. And if you guys were in the webinar again yesterday, we were talking about 1947. That's the level of which I got out of the rest. So I'm no longer holding anything on euro, but that was sort of the last level for me on a target for the pullback play. If we close today below, okay, that gap, which we have filled obviously since, but we're still working with that 1947 level. It continues to leave this thing looking lower. 119.20, 118.60, in my humble opinion, would be a beautiful spot for euro. Possible basing, possible entries for a move higher. This is the 618 retracement, just to the near-term advance, former swing highs, and basic slope support. 3-point touch does confirm this slope, and that converges right down there at 118.60. So the immediate focus for euro, not surprising, still looking a little bit lower, but I don't want to get too aggressive on it. On a side note, guys, we do have some central bank speakers today. Here's the update of the most important central bank releases this week. We get this information from a company that we're affiliated called Prattle, which does research on Fed speak or central bank speak, broadly speaking. They sent us a note today with regards to what to expect for this week from the Fed speakers. So I'm just going to read it to you real quick. Obviously, we have 5 speeches scheduled and 4 policymakers speaking on panels this week. So the Fed is once again the busiest G10 central bank this week. The remarks by Bostic early in the week are unlikely to move the markets as Fed watchers continue to get a read on the new Atlanta Fed president. The speech by Charlie Evans will likely sound similar to the speech he gave in defense of his dissent vote back in December. Remember, Evans did not want to make that hike. Like Evans, Jim Bullard is likely to send a dovish signal as he continues to opine about the dangers of hiking rates too quickly and inverting the yield curve. Thursday's speech by Bill Dudley, the influential and decidedly moderate retiring New York Fed president, is likely to be the biggest market mover of the week. Dudley is likely to espouse neutral or slightly hawkish views as he elevates economic growth prospects in 2018 and points to continuing rate hikes. Rosengren closes out the week with remarks about technology that are unlikely to move the markets. Given the several dovish policymakers are speaking this week, momentum is likely to decline from its slightly hawkish posture back towards neutral. This coincides with a slightly weaker than expected jobs report last week, indicating that hiring slowed a bit, and wage inflation remains fairly low. So remember, that's a quick note there. I hope you guys found that helpful. But just remember, I mean, the Fed pretty much at this point, the markets have been trying to ascertain 3 or 4 hikes. As the economic data continues to move in, markets are barely pricing 2 at this point. So there is room for a little bit more of an improvement in the forecast for interest rates. But as it stands this week, based on these notes, shouldn't be looking for too much hawkish tone out there. And they're citing specifically on the back of the latest release of not only the non-farm payroll figures, but the wage inflation figures, which, as we continue to, highlight here, has really been the Fed's main focus of the dual mandate of price stability and maximum employment. It's really price stability, i.e. inflation, which is the laggard. So just a quick note there. I mean, you have a lot of headline risk from these comments coming out. There's not really a lot in the way of event risk until later in the week. Friday, you do get those CPI and retail sales figures from the United States. Outside of that, markets will be lending a keen ear to some of these comments later this week. So just keep that and keep that central bank calendar handy there as you get through the week. Okay, back to euro. So where it stands for as the euro, the dollar has been making a little bit of a run here. Again, we have the central bank speakers on tap, which could soften the rally a little bit. For the euro, again, continued hold below 1947, looks for targets at 1898. Okay, it's the reversal high day close for November and the November open for that matter. And again, that's 618 retracement. Both of these levels, I'll be looking for possible near-term exhaustion. Here's what it looks like on the intraday. So we threw this on yesterday, saying the same thing that we said on the dollar index. It's too soon to work with this kind of slope with any amount of certainty or conviction, just because you haven't gotten too many plays of it. But something to take note here. The median line offered some decent support. The break saw acceleration, and it was instant resistance. So the slope looks okay. And what that means, guys, is that if we do open the US trade session and we do push below here, we continue to push lower, what do I always tell you guys? The break of a descending formation to the downside will typically be the sharpest part of the move. With the same respect, a breach of an ascending formation to the upside will be the sharpest part of the rally. So this has implications here for near term that this could accelerate lower pretty quick. We'll have to see how the US Open looks like, but as it stands right now, while below that 1947 level, the focus still has to remain a little bit lower here in the euro. The only thing that would invalidate the immediate downside bias for the euro would be a breach here. Basically, you're looking at just below 120, 119.81, former swing highs from yesterday. The median line, okay, for the current slope that we've been following, and the median line for the current downslope that we added yesterday. So if we were to recover beyond here, that would shift the focus back to the upside for the euro. As it stands right now, you're looking for possible support at one of these thresholds. Momentum is an oversold condition, even on the 120-minute chart, even on the 60-minute chart. So again, this is not when you want to try to fight this thing. Just respect the fact that you're really flirting with a little bit more of an accelerated drop here if we do close at these levels. Any questions on the euro, where we stand on this thing? A little bit of a slow grinder, but considering where we're coming from the weekly charts, considering where we're coming from in broader trend, not too surprised to see this weakness here. And again, near term, if we hold below that 47 level, I do expect to see that 118.98 first, and then 118.60 on a stretch would be a possible entry. Questions, comments, concerns? All right, that is number 2, and that's the euro. Number 3 is Aussie. Here's what Aussie looks like. And then you know what? I'll take a look at Aussie Yen for you, Pooja, right after this. But Aussie, we've been looking for the pullback. Now, if you recall last week, the ideal scenario for me would have been a stretch into 78.86, 78.97. This is where we were initially looking for targets on the long and possible exhaustion for a pullback. Obviously, we didn't quite make it there. About 10 pips shy here before we turned around. And as we said yesterday, look for that break below 78.13 to really open things up. If we break below this level, it would suggest again that a bigger recovery is underway here in the Aussie dollar. or for the dollar against the Aussie rather. Here's what the daily chart looks like, and this is why we really wanted to see that 78.86. Former swing highs, nice old 618 retracement of the entire decline. Just a nice spot. Now, as long as we stay above 78, it could still make the run, okay? Here's the monthly open. It's right at 78. Here's the monthly opening range high. And again, that former pivot support. So, as it stands right now, I'm still looking at this range right here. If we get the stab into this region, specifically if it's on divergence, that's for me an entry. If we get a break and a push below the monthly open, that would shift the focus towards the 100-day moving average. That's 77.75. And then again, right back to slope support. And this is our new bullish inval for the near-term trade, or for the broader trade, I should say. So as long as the daily charts are able to close above 77.35, I still think the upside here is warranted. Near term, this is your focus range. Momentum, I want to see the daily close back below 60 or 70 rather. And again, that would be the mark pulling you back from overbought condition and would suggest a little bit more of a downside play is at hand. So some interesting levels here. Here's what it looks like on the intraday charts for Aussie, by the way. I just showed you that, but same region. Same region. And just from slope, okay, I'm not even taking into account measurements here. The break to the downside, again, gives you 77.50, 77.60 as just a near-term target for the first sort of level you'd be looking for. But for me right now, the focus is on support here just ahead of 70. Ahead of 78. Aussie, it's been a slow grinder. I'll tell you that much. You guys remember last month, or I guess I could say last year at this point, we nailed the bottom, 75, 74.99. You guys remember that? We were talking about it for weeks and weeks and weeks. We were holding along. Unfortunately, I cleared out most of those longs here at 76.30. I thought we would have got a more decent pullback to get back in. It's been a straight shooter ever since. So the exhaustion trade on these types of moves, guys, can be very tricky. So I don't want to get too wrapped up, let's say, in trying to get aggressively trying to play the pullback here. But I do want to see this thing move lower. I do want to see it move near 77.35. 77.60, like I said, would be a nice spot. So the focus for me is on a rebound here to get some sort of entry, possibly against these highs, to try to play the break lower. That's the game plan. That's the game plan. Hey, man, great to see you. Says, morning, Michael. I sent you an email minutes before our webinar concerning technical use. I use Euro as an example. Hope to have your answer either through the webinar technical analysis, January 15th. Hey, man, let me take a look real quick. Maybe it's something here that someone else in the room might have a question on as well. Okay, I'm going to read this question, man, because I think it's a good question that a lot of people in the room probably have, and it refers to the euro. So I'll go back to the euro, and then Pooja, I come right back to the Aussie yen for you. So Iman's question says, if the euro dollar daily close at 1945 or above, or excuse me, or below, supposed to be the initial target as well as support, shall I jump short from that level with a stop at 120? Or better to wait for price to take a short position? I got confused when daily closes confirmed that price is correct, but at the same time, it's at support. Any idea how I can trade daily closes while price is at support resistance, but in a way that it's doing its correction against the broader outlook, like the euro dollar? I prefer to address this through the email. Yeah, no problem, Iman. Great question, and I usually don't do this, but I think a lot of people have that same type of inquiry. So it's very important to note, Iman, and everyone in the room, when I tell you guys that I'm looking for a daily close above or below a key threshold to validate or invalidate a specific bias, All that's doing, Eman, is that is a way of ascertaining bias. That's it. If the daily closed, remember, I'll bring up another example. A perfect one was dollar CAD, and this is something that someone asked me yesterday in the webinar, right? We were talking about 23.88, 24.15. This was the last target on the SB Outlook last week for the dollar CAD sell-off. And someone was saying, Mike, it's stabbed below your level, but then it closed above. Is that justification for taking a long position? And my answer to you, Iman, is this. All the close of the day does is give us conviction on whether our outlook is in the right, let's say. So for me, I said a close below 23.88 is needed to keep the downside going, okay, to keep the downside going. The fact that it came, probed 23.88, then closed above, it's not bullish, but it certainly means that the immediate downside bias is at risk. So Iman, just because it closed here, is that justification to jump into a trade? The one thing that I have to tell you is always this, guys. Nothing, absolutely nothing in trading supersedes basic support and resistance, A, and B, your risk to reward ratio. I can't tell you what your risk tolerance is. On a trade like this, I wouldn't have taken it just because it was the weekend close for the first weekend of the year. So I'm not going to jump into a long here against that stop. But let's say this happened on a Tuesday. Hell yeah, I'll take that trade, right? We closed. I have a well-defined low to trade against. The trade is at support. If at 24 you take a long position, your stop is going to have to be at 23.60 or so. It's a 50 or 60 pip stop. If you're okay with that 60 pip stop and your target is going to be up at 25 or 24.90, sure. Okay, a little bit not really my style of trading. I take it more to the near term. So in a trade like this, when the market closed there, you had another opportunity, and that opportunity for me was here on this pullback and overnight. Okay, you want to try to get stop as close as you can to the weekly lows to try to play the breakout. Does that add some color, Iman? And take it back to the euro example that you're talking about. And we were talking about the 1947 level yesterday, right? And you were saying that if the euro closes at 1945 or below, should I just jump into the short? Well, I can never advocate that, Amen, right? You always want to take a step back before you jump into any trade and just look at it objectively. That's always what I do. I look at this objectively. It closed below 1947, like we said. So I'm bearish. Can I sell at 2-week lows? Does that feel right for me to get into a trade short when it's already, 160 pips off the high? So it's not. It gives us conviction on the bias. We were looking down if it closed below 1947, and indeed it has moved lower, right? But that doesn't always necessarily mean it's going to offer a trade, man. And my concern is that if you go by that mindset of, okay, well, Mike said if it closed below here, it's bearish, so I'm just going to stay short. It's going to really wreak havoc on your risk to reward ratio. Now, Iman, don't get me wrong. There is opportunity. There always is opportunity. You can get deep into price action. And now that we close below, you can look for a trigger break. And if you see a trigger break like here and take a stop just against this high, you still have the opportunity to play it in near-term price. But just because it closed at that level, jumping into a short blindly, I'm never going to be able to advocate for that. So the daily closes are absolutely paramount. They give us a lot of information as far as where the market has settled, where the consensus is. And once that gives us indication for trend, then it's right back into near-term price action to nail down the entry and the exit. Make sense, Iman? You always add color to us. Definitely got you. All right, cool. Great question. Great question. I encourage you guys, if you have questions like that, this is, we're here for you. So I want to make sure these webinars are as beneficial to you guys as possible. So I always welcome any and all questions, whether it's strategy-based or trade-based. But good question there. So we went over Euro. We did cover Aussie. I'm going to jump into Aussie Yen here for Puja. Aussie Yen will be number 4 on this session. Here's what Aussie Yen looks like. Let's see here. What is Aussie Yen doing? Dun, dun, dun. See the weekly charts first, shall we? Okay. I have a weekly R1 at 87.95, says Puja, and the yearly open at 87.86. So 87.86 definitely something that we'll be watching, right? The yearly open. And then the good old 87.56. I'm holding short from 88.39. Okay, so I like the entry. Obviously, you're in the money already. The one thing that I didn't have highlighted here was the high week reversal close, and that's actually almost exactly where this thing turned. It's uncanny. Um, Here's your high week close for 2017, specifically made here in September. That's the exact high that we just ran into and turned lower. So one thing I would highlight here, just on the weekly charts, Pooja, is you have the long-term 200-week moving average. I tend to give some credence to these longer-term weekly moving averages. That's basically a pivot zone that you're heading into right now. You said you have a pivot 87.97. Wow. 87.90. You have 87.95. I have 87.97 as that as that moving average. So well done, Pooja. We're right on the same level with that. So that's a near-term target for sure. 87.64, 87.55 is still a big region. Yeah, the good old, that's what you meant by the good old 87.56, right? 2016 open, so it's a 2-year open now at this point. You know, it's not something that usually will carry over into the following couple of years, but was instrumental in some pretty decent pivots last year. And it's also the objective 50% retrace of the entire 2014 range, the decline off that 2014 highs. So the 50 line, the 50% retracement is there as well. So I do like all your downside targets. I do like all your downside targets. This is looking at it again, 1,000 feet up, right, from the weekly charts. So as we drill down into this, knowing that just now we've turned from the high week reversal close of last year, I'm going to copy that level. Let's go to the daily. Okay, so we just added that here in the daily. Looks like we had a level there that we were watching anyway, which was just this swing low from back here in 2015. Here's the reverse. Okay. Let me take this to a deeper time frame. The only thing that's popping out here that you didn't mention is the 88 handle right here. Pooja is actually the 618 retracement of that decline late last year. So it was resistance on the way up before the pop. Could be something here. I wouldn't stress it too much, but let's look even more near term. I do love the momentum signature. You know, the spike high into overbought condition, the break and close here would really validate the 70 break and shift the momentum focus lower. From a wave count structure, it does look like a completed 1, 2, extended 3, 4, 5 type of play. So, you know, I wouldn't be surprised to see a little bit more of a big spill to the downside correctionary pattern before the motive continues. But certainly the level of which you're turning at is pretty impressive. Let's look at the near-term charts and see if there's anything here. Right, so we were working with this near-term channel. I'm a little concerned because the broader trend is up, says Pooja. I'm with you on that, but it's how do I say this in a way that makes sense? Pooja, it's the same play that we're looking at with Aussie dollar. It's the same play that we're looking at with euro dollar, right? They're all still in broader uptrends. But within the broader uptrends, you're always going to get corrections. You're always going to get times of pullback, times of relief where the market takes a reprieve and then resumption happens. So, you know, the magnitude and the depth of the advance here, I would not be surprised to see this thing turn over a little bit more abruptly. I just wish it had more structure to it, which we don't necessarily have right now. So this is the formation that we were working with. The break of the upside saw the accelerated move. And here's again. Whoops, didn't mean to do that. These two targets I'd be looking at near term. I bet you if I take that retracement, the 618 is going to show up in the same spot, actually. A little bit higher. Okay, so we're below that already. All right. Yeah, it looks good. Honestly, I mean, the entry was great on that. It was right before that break of the high that we made a couple of days ago here into the open of the year. So, Puja, look for a reaction here. Settle it into 80, basically into the 88 handle. See how the U.S. market opens. If you start to rebound, I mean, you're short from 88.39. I just have it at break even. I would just have it at break even. Try to see if you can get that push lower. I do think this is a decent turnaround type of play. Okay. Even if you see a little bit of a recovery here in U.S. trade, it wouldn't necessarily get too concerned unless we stay, as long as you stay below 88.40, essentially. But downside levels of interest, aside from the targets you noted, are right on point. I would just put this here, just ahead of that 87.80, 86 target you're looking at. And then I love 87.56. You know how I feel about that. 87.56, 87.60, that whole region. Pooja, does that help? A break of 88, clear out the 87.60. Yeah, that's what I want to see. That's what I want to see. Yep. I wouldn't even wait to the whole 80, 87, like 50 deep part. I would keep the limit on the upside, 87.60 on that. Because actually the retracements and extensions and dip lows actually extend between 86.66 and 86.65. Excuse me, 87.65 and 87.66. So, I'd hate to see you just wash out of that because of a pip or two. But yeah, that would be my game plan. I'd be looking for something here. Honestly, Pooja, it wouldn't actually be a bad idea on this decline. If you get deeper and you get into this 88 handle and it struggles a little bit, take a little off before breaking even on the stop. You got a decent 40 pip extension. It's coming into near-term support. No reason not to take a little bit off there. But I do think if that clears, yeah, your next level, 87.60, 87.50 should be a really nice target. Should be a real. I mean, that level has been pretty definitive for a while. We've been following that threshold. Longer term. It's the 50% retracement from the entire 2014 decline. Big level. All right. Okay, thanks. She says, you got it. You got it. Interesting trade, Aussie Yen here. Interesting trade. Let's see if we can't get some structure here, but I do like it. Okay, moving right along. That was number 4. Number 5, I want to take it back to the crosses real quick. Here's Kiwi. There's no play here. There's no play here, and there's no play here. I'm going to say it over and over again, but I do have a very, very high keen fix on this. And if we are going to play Kiwi weakness, like I said earlier in the session, I do think there are alternative pairs that you could reflect that opinion outside of Kiwi dollar per se. But look, here's my problem with this, guys. It's obviously in a near-term uptrend. It's seen a breakout of an ascending formation. We just talked about this early in the session. The breach of an ascending pattern typically is the sharpest part of the move. It's exactly what you're seeing. But it's at downtrend resistance. Okay, the 50 line for the current formation that we've been following off the highs from 2016, excuse me. And you're seeing that price is really struggling to make or surmount some sort of rally through that. So momentum is an overbought condition. That's never when you want to start fighting it. Again, if it pops through here, there's really nothing to stop the thing from going straight up into 72.60. But I'm not buying it. I'm not buying at the highs, and I'm not going to get sucked into this trade. I'm still looking for a possibility of an exhaustion. Playing the short side, like I said, through Kiwi dollar might not be the best play just because it is so pent up, guys. The advance has been pretty radical. You know what I mean? I'm not a big fan of trying to stand in front of a steam engine like this, trying to call the short. But what I do want to do is look for some sort of pullback corrective play to give us an entry back on the long side. Near-term support on the weekly chart is reflected right down here near the 71 handle. You have the 52-week moving average, basic slope support, and this was a 3-point touch. Confirmed, pivoted, broke on the backside, pivot to the upside, and yesterday it was perfect support. So that converges on that 52-week moving average, just above the 71 handle, top side 72.61, just above that, the 200-week moving average. So the range is very, very clear and critical. This is why I'm really not keen on trying to take a short here because, it could right plow into 72.60 before turning over. I don't know. But the daily chart has this thing in overbought condition, so I'm not going to try to short that yet. Okay, so no changes on the Kiwi setup that was presented. What day was that? I think on Sunday night. Here are the Kiwi levels. And basically, literally, all we've been doing, guys, is straddling that measured move. Don't forget that 7160, aside from the reason that we just talked about with that daily slope on the daily chart, is the targeted measured move for the consolidation breakout that we were following. Y'all remember this. Throughout November and December, the price was consolidating in this triangle formation. Classical technical analysis 101, break of a triangle formation, the measured move, okay, takes the widest part of the range. An extension of that gives you a target at 7160, and here we are straddling 7160. So this is the reason why there's a lot to suggest that, all right, you made the objective measured move, you've made quite a decent rally, it's been a 4-week rally in a row, momentum's overbought in the daily chart, I can't buy up here. And at the same respect, you just don't have the conviction to try to short this yet. So a pullback, great. This is the first slope you'd like to see a reaction at. It's only 3-point touch, so if it breaks right through, entries at 70, 78, 70, 77. This is also my near-term bullish inval. So as long as price stays above that, we're still looking for that broader pullback to get long. Okay, 72.60 being still a major key top side target for Kiwi, both from slope and just basic lateral Fibonacci support. Right, and slope. So levels are pretty clear. Any questions on Kiwi? So we'll take a quick segue here into sterling Kiwi. And that was one I told you about earlier that I think for me, I've been looking at. So I was looking to get the bounce. It hasn't materialized yet. I haven't taken any positions on it yet. This is basically where I want to see hold, like right here, for a couple of different reasons. But with the same respect, just like Kiwi dollar, okay, a break here, there's another, 100, almost 200 pips to the downside if this breaks. As we said, a downside break of a descending formation will typically be the sharpest part of the decline. So if we break here, expect 86.40 in a hurry. With the same respect, you're getting some divergence in near-term momentum. Price action has continued to make a series of lower lows on the close basis. The oscillator has been unable to prove or validate any of those new extremes in price. So it's looking a little tired on the near term. The daily chart is converging not only on the lower parallel here, but you also have the 100-day moving average. So again, those longer-term moving averages offering some clarity here, okay? Here it is from yesterday. We're there right now. This is where support should hold, if we're going to get some sort of near-term recovery. And again, pound Kiwi higher, that would be a Kiwi pullback, and this would be a nice way to reflect that, I think, if we do get the hold. But right here, again, at this instant, I really can't get excited about taking the long just yet. We just dipped into this region. We're holding here right now. The weekly chart, by the way, this is why I was a little concerned. Here's the weekly on Sterling Key. Okay, so essentially, the weekly chart highlights 86.41 as well. It's the basic 38.2 from the advance off the lows from 2016. Now, this is a broader slope. This is not reflected on the daily charts because it's too messy. It's much longer term. This is from 2016 lows, but you can see that the lower parallel has been holding this rather well. In time, that converges over the next 2 weeks on 86.40. Okay, so could be in for a little bit more of a sideways to lateral lower movement before you start to actually turn higher. The weekly chart's something we'll have to come back and redress at the end of the week to kind of see where we are. But with that in mind, that's just the risk I wanted to show you of if we do close below that daily support, 86.40 is a target that shows up on every time frame. For me, I'm still looking for signs of exhaustion. Still looking for near-term price action to show me a little bit more that this thing is getting tired. Right? Here's momentum, really unable to even get down into the 30 oversold section. We want to start to see support near 40. On whole, I would say that if we do recover off this level into US trade, which is my favorite scenario, the weekly opening range is well defined and well set. Here's your Monday, Tuesday stretch. Look for that break to give you the near-term guidance. Like I said, ultimately, would like to play the recovery near 89.80 on an upswing here, maybe even this slope before turning lower. But the premise is all on this action. We need to see some sort of reaction at this level. Okay, and if the U.S. market's open and this thing roars back higher above 88.80, I do think you get a little bit more of a recovery here in pound key. Good way to play the Kiwi weakness story if weakness does materialize there. Questions on sterling key. I know it's an interesting pair, but it's got a decent ATR. The ranges are there. Let's just see if we can't get volatility start uptick a little bit, because this is getting kind of tedious. So hopefully we'll get this thing moving. Look for a hold here into US trade today. All right. Last but not least, we have crude prices. Here's what crude looks like. And then we'll take a look at dollar CAD actually. So here's crude. This is another trade that we've been following very closely. If you guys take a look at the previous update from last month on the 27th, we were looking at the crude prices after having just broken the consolidation pattern. So remember, just like the consolidation pattern that we were looking at in Kiwi dollar, here's a very similar one that we were looking at in crude prices. Okay, this is off the lows that we made in November. All throughout the December trade calendar month, we continued to consolidate into the apex of this formation. Once we broke, 60 was the first major target. We thought we'd get a little bit more interruption here, but the measured move, again, technical analysis 101, measured move of that stretch, target 63.23. Okay, we had a first target at 62.56, 2015 high, and the final target up there at 63 and change. So, fast forward to last night, obviously we got that break. Still looking for an extension to 62.56. So I was telling you guys last night. And as we get into these regions, guys, by the way, let me take a step back. These two regions, if we extend into them, specifically the 63 handle, I'm actually looking for a larger turn. Okay. That's both from a seasonality approach, that's both from a daily chart approach, and from slope structure. That would be an area which, if we reach specifically here early in the week, would be a very convincing, in my opinion, opportunity to try to short this thing. Now, again, we'll need the momentum indicators to sort of follow suit, but here's what it looks like right now. Okay, you just missed 62.56 by a couple of cents. The high was 62.53. So he missed it by about 3 cents on the upside there before pulling back. I still think it's got some juice to try to make another run on it, but the levels remain unchanged. And into this week, if you're not already long from here, there's nothing to do. In fact, we're looking for exhaustion. Okay, we're looking for exhaustion in this zone. Ideally, like I said, ideally, you get the stretch into 63. That would be the measured move for the consolidation break. It'd be perfect as far as where it would hit in time, with the median line that we've been following and price action on the daily charts converging right on that level. Add to that near term, okay, just the slope that we've been following on the 240-minute charts. This is just basic channel. 1 touch, 2 touch. Extrapolated off the high. Here you have 3 touches. That converges again on 63.23. Any way you slice it, 63.23 keeps coming up as a level of importance. Okay, so if you're not long on this, I wouldn't be doing anything on the long side. If you are long, I'd be shaving off some at 62.56, maybe even as much as 2/3 of the position, guys, because this is the high risk zone. And certainly if you get into 63.20s or above, I'd be looking to close out any type of long exposure, and I'd really be on the lookout for more of a sort of a vulnerable spike high type of exhaustion play. Does that make sense, guys, on crude prices? Pretty huge here. This is a big level, and I think it's going to go under the curtain. Not really people are talking about it. Everyone just seems to throw out, like, you hear NBC or CNBC or all these talking heads just throwing out round figures and stuff. Oh, 64, 63. Well, let's hold our horses here. This is a pretty big region. The broader trade's constructive above 59. That does not change, okay? We would really need to see an aggressive break below 60 to get this thing bearish. It's still within the confines of this broader uptrend, but we are extending into uptrend resistance. Okay, divergence in momentum on the intraday charts has started to manifest itself, but that is not manifested on the daily. And remember, I'm very, very rarely going to try to issue a short trade while this thing isn't overbought on the daily scale. This is when the market has the most push, okay? Not when you want to start fading things. If we make it back below 70, especially after a rip, that's sort of the conviction that we're looking for. But near term, I'm looking for an exhaustion trade into 63, essentially. I think this is going to be a bigger one. I think this is going to be a bigger one as we get deeper into the week. A lot of people are staring at these prices with great interest, and certainly where it stands for dollar CAD, trade that a lot of us or that we've been following here on SB as well. Nothing to do here either, unfortunately. The last dollar CAD update was right here. And we were talking about this major key area of support right here between 23.88 and 24.15. Go back to Iman's question earlier in the session. I needed to see a close above that to even suggest or entertain the idea of playing a rebound. And while we did skirt below it, we closed well in the range, to the upper part of the range. And the next following day, still same thing. We tried to break below, and again, we closed above. So seeing the critical nature of this zone, the Fibonacci consideration. This is a 618 extension from the decline off the highs that we made in 2016. It's also the 618 retracement of the advance off last year's low. And certainly from a closed basis, like I said, it's been pretty rock solid. Pretty rock solid. So how do we play it from here? Well, it's a tough one on this one, and the volatility just isn't there. So for me, if you're sitting in a long from yesterday, I give you more guts than I had. I kind of wish I was in it because we were even talking about it in the webinar. I do think you get the extension to 2487, 2485 for sort of an initial target, but I don't want to get too excited on this one. Momentum is trying to recover from the oversold condition, and that would further validate the sort of rebound play. But don't get too aggressive. Okay, for me now, as it stands, I'm looking for the recovery to take us a little bit closer back to the 25 handle before you start to get concerned about resumption or anything. Any questions on the loonie or crude for that matter? All right, and guys, those are the trades that I've been following since the start of the week and that we've been following over on SB. Let me know if you have any other questions or trade setups you guys want to review. We have to see on this wait and see game until we get some pop here in price. Oh, we didn't hit Euro Aussie. One last thing. Oh, that was number 8. Euro Aussie is another one that we covered. So here's Euro Aus from last night. Obviously, we were talking about this key region of support. Market is trading into it right now. Here's Euro Aus. Okay, the region is 52.30 into 52.50. It's actually 52.26 to be exact. But you're basically looking at the June high, which has been a decent pivot in price in and of itself. You're looking at downslope, near-term downslope support. So again, you're looking at a very similar situation that we are with Euro, with the pound key trade, right? In that if this does break, downside break of a descending formation, for here, could be a real drop. But that said, you're coming into support. You're simply coming into downtrend support. So for me, I'm looking for momentum divergence in price. As a disclaimer, the long is already in. I thought that last night we were going to get a nice push, and while we did see a nice stretch into 52.70, a little disappointing to wake up this morning. We're right back at break even again, just a little bit in the money. So look, I do think that we need to respect this barrier. If it breaks this low, like I said, you're kind of in a big pickle at that point, I think, just because of the nature of all the stuff that's kind of wheeled itself all into the 52 handle here. If it does give out, there's really nothing for 100 pips. You literally should see this thing drop into 51 rather quickly if we're wrong on this trade. So for me, I'm looking for more evidence here before I start to execute more on it. If we get stopped out at a quick stop on the break of the lows, so be it. but it is a pretty big technical feature. It's a pretty big area, and I would like to see just a little bit of a rebound here. Remember, when we're looking at these near-term trades, guys, we're not trying to validate a reversal of the broader decline or anything. Recognizing opportunities where they stand, and as it stands right now, this break could give us a little bit of a near-term recovery. Maybe even check former channel support as resistance before we move off. I don't know, but as it stands right now, momentum hasn't really made a deep cut below 40 that much. You're seeing divergence obviously start to manifest itself on the near-term charts. I do want to see a little bit of a recovery here in Euro Oz. Okay, that would coincide with the Aussie pullback. Another way of playing Aussie weakness without having to take a long dollar. So, especially if we do get this break below 78 in the Aussie dollar, I think that Euro Oz trade would play out even better. A quick look at Euro Yen also, please. Level to eventually go long, Pooja. Let's take a look at Euro Yen. Let me jot that down. JPY. Euro Yen. Let's see what we're doing today. Okay. Near-term support's right here, Pooj. We're at 134.28. You get some former swing highs. 618 retracement. Now, this 618 is a longer term from the decline off the 2014 highs, so it's a little bit longer term of a play, but it's been a decent pivot in price. Talk to me here, Pooja. What are you trying to do with this? Are you trying to do a near-term rebound to go long, or are you trying to take advantage and you think you're going to get resumption of this broader uptrend? Because with Euro Yen, the weekly chart has really been the only thing that I've been following closely. And I think you can see that as I was skimming through the charts. This was a big spot for me. Okay, this is the 1618 extension from the advance off the lows. So it's a measured objective target and basic slope. Now, I know this doesn't look like the cleanest thing, but we're basically using the yearly January opening range low, which acted as a pivot on that same slope, and then literally caught that same section right there. It converged at 136.30. It's the 1618. So the pullback here, is this going to be just a blump and then a break higher? If we breach the highs that we make now, I think 141 is easy. I think that's easy, and that's not something I say lightly. But as it stands right now, it doesn't scream resumption to me, Pooja, just yet. If anything, I'd want to see a rebound off of structural support to get long. You're at support right now, lateral support, 34.28. That's it, 618 retracement. But also, like I said, the former swing highs here is essentially basically the September opening range highs and the December opening range highs and the November-December opening range highs, which broke obviously late in the month. So do this, Pooja. Take a quick snapshot of this chart if you'd like. This is very basic stuff, just slope analysis. Highlights 134.28 as near-term support, 136.30 as near-term resistance, and again, the break I think is a pretty clear-cut shot to 141 on the upside if you do get it. Let's go back to the closer time frames. This is going to be your first tell here, Pooja. This is going to be your first tell. I think if 134.30 breaks down, hourly RSI is 25. Therefore, wondering where to look eventually. So if this does break down, okay, then that's a good point. You look for structure on this, Puja. You look for some sort of high, low, high to give yourself some sort of indication on slope. This is going to look really ugly, but I just want to see what it looks like. So bear with me for just a moment. Yeah, it's way too early to work with that, but scratch that. Okay, so basic advance of the basic retracement of the advance off the November stretch high gives you some interesting levels. So if 134.30 gives out, slope on the longer term actually converges on the 50% retrace. That's just right around 34 handle, 33.90 Puja, right here. And then honestly, look, the 50 line doesn't really catch the lows, but if you move it, the slope actually does. So that gives us conviction that the actual gradient may be on track here, and that would put the next basic region of interest down basically at 33.50. But look, on its face right now, it's at initial support and the momentum signature is at 30. If it's going to charge some sort of near-term rebound, it would be here, Puja. But my humble opinion is that this is not the rebound that would mark resumption of the broader uptrend. If you're looking to play like a 20 pip bounce off this really, really short-term stuff, that's something different. But looking at this objectively from my standpoint, to play that kind of move on this, I would want either a drop into the median line of the upslope that we've been tracking, which is on the 50% retrace, or if this downslope is in fact intact, then that would be the next area you'd look for a rebound. And in such a scenario, you'd be looking for a basic play into 34.30, like an 80 pip run here. From right here, I think it's difficult to try to get into a fresh positioning. You certainly don't have any type of conviction on a stop for a short from here. And the long, like I said, I'd want to see a more conviction sort of confluence region to try to fight the decline that you just made. You just sold off from 136 to 134. You're down 200 and some pips. So try to capture this knife. I'd rather see it bounce in price first, play it against that low, and try to play the recovery to the upside. Does that make sense? Does that help? Who just says thanks? All right. Right on. I think 134.30 breaks the hourly RSI is 25. Okay, I got that one already. All right, good. Good. Okay, guys, any other questions before we wrap things up? We will be back tomorrow, same time, same place, for another intraday webinar. I do want to give a quick housekeeping, guys. I'm going to have to be out one day this week. I don't know when yet. I did get some unfortunate news of a death in the family today, so I will be having to travel for that. I will keep you updated. As it stands right now, though, the schedule is unchanged, so I should be here still tomorrow and the day after. If there are no other questions, we'll wrap it up here. Guys, best of luck trading. Keep it light on those pairs that we talked about and really watch today's close, specifically on the dollar CAD on that low support. On Kiwi, okay, it's been ugly, but the daily resistance, that's sort of the focus for me. Is the daily close going to materialize above that slope or not? I still think the risk is for a pullback. Price needs to come through and really suggest that. And then the crosses, the Euro Oz, trade, which is coming into that big support that we want to see the bounce from. And same thing with pound kiwi. Pound kiwi with that big support, again, that we wanted to see the bounce from. So keep both of those in play. Be careful on trying to play the recoveries and the rebounds, okay? If you're going to take a counter trend trade, it's still early in the month. Let's keep our leverage lower. As we get these conviction and the monthly trends mature a little bit, we finally get those OR breaks, I think we'll get a little bit more clarity and a lot more confidence to get aggressive on this deeper into the month. All right, best of luck trading. See you guys tomorrow. Cheers.